All right. Hello, everybody, and welcome to Investing Education Academy's discussion today, where we're going to talk about market correction versus bear market. You know, sometimes we know the difference, sometimes we don't. So before Leon tells you why we chose that topic today, I wanted to say we are still celebrating our 1-year anniversary. Thank you to all of the new members who have joined and taken advantage of our between 20 and 50% discounts on membership. For everybody who, one of the questions came in today from somebody who joined yesterday. If you join and you receive the 50 or 20% discount on membership, yes, you are locked into that price for as long as you choose to stay with Investing Education Academy. It's not just a discount to get you in and then we're going to switch prices. That is just your price. So again, if you've been on the fence, you've been thinking like, should I, shouldn't I? You probably should take advantage of these discounts. Leon and I have discussed it, and I know you hear this on commercials all the time. We're never doing this again, but it's a high probability you won't see a 50% discount on membership again. Like, it just is real. Like, we really do mean it. You might be some things in the future, but you probably will not see a 50% discount. So if you are thinking about it, this is the time to do it. And really at 50%, you got to think about it. That's almost like getting every other year free. So, you know, you really want to take advantage. So that being said, welcome all of our new members. Everybody who's thinking about it, feel free to join. Now, the question did come in as well. What about the IEA crypto bulls? What's going on with this cryptocurrency? There is no discount for that group. That group is $200 a month. We're now, I think 16, 17 people, something like that.
17.
17. So 17, our cutoff is 25. So, you know, we're slowly and at the same time quickly approaching that number. So if you are interested in getting to our cryptocurrency group, it's $200 a month. Once we hit 25 people, we are closing the group for a few months, and we're going to switch to our second group. And instead of it being $200 a month, it will be $300 a month. So those of you all who are right now like, oh, crypto's had a pullback, you know, I'm really not focusing on that right now. When it goes, where will you be? That's all I'm gonna say. I'll just put it like that. Don't wait until you think the market is starting to run again. So, oh my gosh, I really do need to join that group, because some of the conversations we're having in there could make you significant amounts of money. So I quote my own stuff. So while I do a little bit of housekeeping, Leon, please tell them why today we chose correction versus bear markets.
Yeah, just on the cryptocurrency thing, and kind of goes with the topic. 2017, 2018, the cryptocurrency market corrected by 91. Well, you could actually say bear market. It dropped by 91% in 2018, and then went from $20,000 to let me change that back. Bitcoin went from $20,000 to $3,000, 91% correction. And then we all know what it did from there, right? And the term I just use the term correction. You could also use the term bear market. In crypto, it's not really defined yet what really a correction is, what a bear market is. But you know, a 91% pullback, bear market being the worst of the two between correction and bear market. Cryptocurrency, Bitcoin was definitely in a bear market in 2018. And I remember at that time, everyone ran for the hills. They were like, this whole thing is a scam, never make any money at it. A lot of people lost money. But the people that stuck around with it or even got in at those lows around 3,000, you know, went from 3,000 to 64,000. So it's just like Brent said, during these times of pullback. So I'll just say this real quick. It amazes me that stock market, cryptocurrency market, Forex, whatever. It amazes me that these are the only things in the world that we do not like sales or discounts. We love sales and discounts on houses, on homes, on cars, on clothes. But as soon as the market gives us a discount, we run for the hills. Like we run panicking with our hands in the air, like, oh, this whole thing's going to zero. Versus looking at it as these quality companies or the quality coins or this quality asset is on sale. Let me get in some now and then, you know, ride it out once it does turn around. It just boggles my mind that people run for the hills when markets give you a sale, but they'll stand out, you know, lines outside of Best Buy to buy TVs that are on sale. Blows my mind. But
you know, Leon, you know, again, let's just do what we do, right? Let's go on a tangent for a minute. I had a number of people like, I would never invest right now. The market's going down. So in my mind, I was thinking, are you waiting for it to go to its high and then you're going to invest? And Warren Buffett spoke about it. He was like, when people run away from the market, that's when he runs towards the market. When people are running towards the market, that's normally when he exercises caution. What is your plan, people? Like, what are you planning to do with your money? Are you leaving it in a savings account because it's safe? You will lose. I mean, this isn't even me and Leon saying you'll lose against us. You'll just lose in life. I mean, inflation is beating it. The market's beating it. I mean, really, I'm not even a fan, but you can buy corporate debt. It's going to beat it. And we don't even talk about corporate debt a lot, but I mean, it's an option. But so anyway, if you're in a savings account and you're just watching this and you're thinking exactly what Leon said, well, the prices are down, so I'm not buying anything. Why would you go buy a car when it's 4th of July sale? Why do you run to Saks Fifth Avenue when they're doing their end of the season sale? Why do we go to all these things when we look for the sales? We'll wait for a Black Monday sale or Black Friday, whatever it is, but we won't look at the stock market the same way. Nope. And this is one of those things, 10 years from now, 5 years from now, when you all are retiring, when your kids are going to college, when your kids are getting out of college, when you're looking for the next house, when you're trying to figure out, what is the next phase of my life looks like, will it look like, you will regret not making a move. And we're trying as hard as we can to spread the message. And there's a lot of organizations and brothers and sisters out there spreading the message. Listen, there's some people out there that I think they're snake oil salesmen. And, hopefully you'll avoid them. But there are a lot of people talking about this because it's very important, especially when you talk about wealth in our community. We're hundreds of years behind. And
just another quick example before we go into the topic. Microsoft. We all know Microsoft. A lot of us own Microsoft on the stock. We all use their products every day via Windows, your laptop, your desktop, your phone, whatever, your car. Microsoft was what a lot of people consider dead money. And I believe it was the early to mid 2000s. Microsoft was in a correction, right? It was either a correction or how you look at a correction or a bear market. It kind of went sideways for a couple of years. And a lot of people ran away from Microsoft because they were figuring, okay, it's dead money, it's a bad investment. Microsoft today, it either is now or was a couple months ago, a couple weeks ago, the most valuable company on planet Earth at over $2 trillion, with a T, $2 trillion. Had you bought Microsoft back in 2005, 2006, you'd be looking at some serious return on your money because you bought it when it was unpopular. You bought it when Microsoft was in a correction and or a bear market. And this is what we're trying to get through to people. We got to get out of this mindset of fast money that, every investment that we make, we got to have a return, within a day, a week, or a month. That's not the way the market works. That's not the way any real asset works. Things take time to appreciate over time. As we always say, time in the market is more important than trying to time the market. And so go back to our topic today. Our topic today is corrections versus bear market. And the reason we're having this topic is because I just know, well, for me personally, I've been using these terms like everybody knows what they mean. And inside IA, inside our platform, some people were I could see people didn't know what I meant by correction, bear market correction. So I was like, okay, we need to take a step back and kind of introduce what these terms mean. Because to Brent and I, they're just, they're like using the and. It's just part of the lexicon of finance. But not everybody knows it. So we want to introduce what these terms mean. And they're not only what they mean, but actually they're kind of markers in the sand that kind of give you an idea how well or how bad your investment is doing. So we're going to cover corrections and bear market today. And Brent, you can pull up the slide when you get a second.
And Leon, for everybody who's signing in right now, and for those of you all who are listening to the podcast, let's have some action-oriented goals, some call to actions, if you will. When we're done, or if you can share this right now, share it with somebody on Facebook. Call somebody, tell them to listen to it. If you listen to our podcast, send them the link. But also, when you walk through life, if you have a friend, if you have a family member, if you have a spouse, girlfriend, boyfriend, grandparent or parent, just ask them, where do you save your money? Just ask them. And if they say savings account, primarily, because many people have 401ks that they never ever did anything with, they forgot they're there, They don't reallocate it. So I'm not even gonna go on that because that'll take a while. But just ask them where they save money. And for anybody in your ecosystem, if they say a savings account, ask them if they know what the interest rate is. If it's anything below 1%, for those that know, because most of them won't know, but for those that do know, if it's below 1%, at a minimum, a bare minimum, please listen to this, it will take at least 72 years for their money to double. And tell them that. If it's 1% or lower, just tell them, did you know that means that your money isn't going to double for at least 72 years?
Which is like the life expectancy of humanity, right? So like if you're talking to somebody who's not a newborn, they're essentially never going to see their money double, right? So that is just crazy. And we're not gonna belabor this point because we do all the time. But the average interest rate on a savings account in this country in the United States is 0.05%. And as I said before, Brent should have said, if you have 1%, you're going to take 72 years. At 0.05%, I did the numbers. I don't exactly remember what the exact number was, but it was either it would take 1,400 or 1,700 years.
I think it was 1,700.
Okay, let's say 1,700 years for your money to double at 0.05% if you're earning that much in a savings account, which is the average rate in the United States, which is just absolutely ridiculous. Okay, so Brent, you can pull up the slide. Slide one. So like I said, we're going to cover corrections versus bear market, what they mean and kind of what they are. And like I said, they're really good markers or kind of lines in the sand for you as an investor to know, like, okay, do I need to start looking at my portfolio now? How are things going? Am I doing well? Am I doing bad? Am I fine? What have you? Could you increase it once, Brent?
No. Yeah, I can't. Yeah, it's going to go. It'll probably go off the screen.
Oh, no, okay, don't worry about it. All right, now we're good. So, that's good. Yeah. No, just go back two. Hey, Brent, reduce it two.
Oh.
And then go up one.
Are you playing around?
No. I mean, it was like right there. Yeah.
That's exactly where it was.
Well, all right. Don't worry about it. Don't worry about it. All right. So what we have on the screen is a slide. We have 5 bullet points. And we're just going to walk through what a correction versus a bear market is. So essentially, the definition of correction in the stock market. We're not talking crypto, just mainly stocks. Correction is when the stock market or an individual stock drops by 10% from its recent high. So simple math, if you have $100 stock and that stock drops to $89, you're now in that stock is now in a quote unquote correction phase because it's dropped 10%. And these are just hard, these actually are hard definitions for these terms. So just know that, if your stock is down 10% or a little more, that stock is in quote unquote a correction. Second term is a bear market. Sorry. So what is a bear market? A bear market is when a stock or the general market drops by 20% from its recent high. So let's take COVID, right? The COVID dropped in March. The market dropped 35% in about 30 days. So that was a deep bear market because remember, a bear market is when the market drops by 20% from its recent high. The general market dropped 35%. So that was a very, very deep bear market. Now, like, what is a bear market? What is a correction, right? Bear markets are the term bear market just means essentially the market is down huge. There's really no characteristics behind it. Like, and I was saying earlier, they're just kind of markers in the sand to tell you, okay, generally at 20% or more, you're down really, really massive. This is kind of an outlier move for the market. These are rare. So you'll know at that point, if the market or your stock is down 20%, it's in a pretty rough spot at that point in time. A 10% pullback or correction. These aren't seen as bad. These are actually seen as healthy for the market because they allow, like, if you're in the market already, you're looking to buy maybe more shares of a particular company. If the stock pulls back 10%, 12%, that gives you an opportunity to get in, right? So corrections aren't really seen as bad. People that are in this field really look at them as positive because, like I said, it allows them to buy that stock or the general market via like the S&P 500 at a discount. Third point is that two phrases that kind of go behind these. are correction, quote unquote, correction territory, or quote unquote bear market territory. So you may, like I said, if you have a stock, it's $100 stock, and it's now trading at $89, that stock will be considered in correction territory because it's now down 10% from its high. Now, if that stock is down at, say, $79, down 20%, a little over 20%, now it's in bear market territory. And these also apply to the general market as well. If the S&P 500 is down 10%, it's correction territory. If it's down 20%, it's in bear market territory. Now, like the next point is saying, most professional money managers don't pay much attention to pullbacks in the market or in their stocks until they reach correction territory. And that's kind of a loose and fast thing. I mean, everyone's different. But like I said, 10% correction is kind of a line in the sand for individuals and professional money managers to say, okay, maybe I need to just kind of, perk their ears up to say, okay, let me see what's going on in the market, or let me see what's going on with this particular stock to see, do I need to pair some of my gains? Do I need to buy more? Is this just a general market correction where it's not really affecting my company's fundamentals? So it's just kind of, like I said, a line in the sand to kind of wake people up and say, okay, let me just revisit what I bought. And then when you get to a bear market, that's when, a lot of times, or even before that, maybe between 10 and 20%, that's when people will start to take action. They'll maybe trim their position, maybe they'll buy more, or they'll get out altogether. Just kind of depends. But both of those 10%, 20% are just areas where people then kind of pay attention to what they bought in the past.
And Lee, I think one thing should be noted too is many of these terms and even the numbers are just old, and they're old definitions. They haven't been changed anytime recently. And there are a lot of people on Wall Street that think the numbers need to be changed because much of this is based off of companies when they had, like a earnings per share never exceeding like 15%, or they much more stable companies with valuations that were much more realistic. These companies don't exist like they did, when these definitions came out. So there's a lot of people in the industry, even back when, quote unquote, I was in the field, they thought that this needed to be revamped, and they don't agree with the numbers. And also too, you got to know the behavior of individual stocks, because some stocks will move beyond 20% in a given day because that's their natural behavior. So you have to know the difference between an overall market move and individual stock movements, because some of you all might be listening to this going, oh, well, my stock, just moved or went higher, lower 20% sometime this week or last week. That's not the same as the overall market moving. So just understand there's a difference between individual stocks and overall market. And these terms were defined when the market was middle-aged, if you will. And I think it could stand to be revisited personally. But that's just a philosophical.
No, that's a good point. Yeah, so the market, when these came out, I don't know, like who knows when these came out. Well, I don't know when these were actually established, but
I think it was like the 30s.
Yeah, I can see that. Yeah, so the market today is way more volatile than it was, even 10 years ago. I mean, much less, 50, 70 years ago. So yeah, Brent's right. These terms, these terms and these benchmarks or these levels are old. However, but they are still used generally by Wall Street and generally by investors in general. They do, 10% is considered a correction. It's considered a healthy pullback or time you want to revisit. 20% is considered the bear market, where you're like, okay, something's really happening here with either the market or my stock. But Brent made a good point though, also. And one of the things I always talk about is volatility of the stock you're in. If it's average range per day, if it moves 12% per day, you can be in a quote unquote correction every day, right? So like Brent said, you also need to understand the characteristics of your particular stock. But for the general market, like I said, you're tracking like the S&P 500 to see what the market's doing. These still hold fairly true, at least by Wall Street standards, because the general market, the big indexes, they only move anywhere from 0.5% to maybe 2% per day. So if the general market is down 10%, that's actually pretty big. For individual stocks, yes, it's very important to understand how your stock moves on average per day, because it could be in correction territory, daily, depending on what its volatility is. So that was definitely a good point, Brent. Last point is, since 1950, there have been 26 corrections, but only 10 bear markets in 71 odd years. And I actually thought I thought it was a lot more than those, but when looking at the information, it's actually on 26 corrections and only 10 bear markets in the last 71 years. And Brett, if you can pull up slide 2. So what this slide 2, if you could zoom in a little bit. So what this slide is showing, it's basically showing the frequency of corrections and bear markets, and then actually how long they actually last, right? So in red, you can see on the screen, red, all the ones highlighted in red are bear markets when the market pulled back 20%, and everything else in blue is when the market pulled back 10%. And you can see when the market's in a bear market or stocks in a bear market, from peak to trough, it's a lot longer. It takes a lot longer for that thing to drop than it does, a correction. So I mean, if you're just looking at this, I mean, some of these are 622 days from peak to trough for a bear market, 630 days, 543 days. So these bear markets can be long and painful. I mean, they can just kind of whittle their way down, and I mean, sometimes they don't drop like a rock. They'll just take forever. I feel like the market will never go up again. Taking, I mean, these some of these like maybe a year and a half, 2 years before they turn around, versus the corrections that are when they pull back only 10%, you're looking at 18 days, 35 days. Some of them are a little over 500, 63 days, 87 days, 20 days, 45 days. The bear market we had in March of last year, the COVID drop, that was the fastest bear market, and it dropped 35% in 30 days, and the quickest recovery, where it took a month to recover. So it only took about 30 days to recover, which is really, I mean, looking at this slide here, there are no bear markets until that one that went peak to trough in 30 some odd days.
Yeah, I mean, but that was driven, by global health scare. So I think that's different than the natural occurrence.
Yeah, COVID it's a once in a generation pandemic. So that probably wouldn't, I mean, it'll make this list now, it'll be updated, but it needs to have like an asterisk next to it. But so just know that typically bear markets can take up to a year and a half to maybe 2 years to go from the high to the low and then start to recover. Whereas corrections, which are 10%, can do, they can fix themselves in less than a month. In some cases, maybe 2 months.
Some of you all might be listening going, well, how does that affect me? How does that affect my money? When you know information like this, you can, number one, definitely go into situations less stressed. So that's important because that affects your health. Let's start there. But then also a piece that Leon always talk about is a lot of psychology and just emotional responsibility that goes with investing. And when it's like your knee hurts and you go to the doctor and the doctor's like, oh, that's actually normal for, what you did yesterday. You immediately feel better. Your knee feels no different, but you just feel better because a professional told you that it's normal and it matches the symptoms you're having. So you go home with basically the exact same feeling, a tremendous amount of less stress. We're providing this information to you so you can understand some of this market behavior is just normal. And to stay the course and not make a judgment based off of just not knowing or lack of information. And also too, when you look at this, and even for me, some of these numbers, I'm like, okay, how long do I have to basically accumulate more investments? So when that correction or, we get back to a place of normalcy and the market starts to rise again, I can be in a position where I would have taken advantage of the stocks that are on sale. So, this type of information, when used properly, really can help you strategically position your portfolio for maximum growth in later years or in later months in some cases.
Yeah, and I would say really think about these numbers in terms of the general market. So, and I mean, I encourage everybody. Like, I think everybody that's investing in the stock market should have on their watch list the ticker symbol SPY, because that is the S&P 500, and that tells you that's a gauge for the entire market. So if the market, if you get up in the morning, you see, oh my God, your stocks are down, 5-6%, and you wonder why that is. Go look at SPY. If SPY is then down, say 0.5%, maybe 2%, maybe 1%, okay, the general market is down. That's why your stocks are down. So I encourage everyone to add SPY to their watch list. But I would say, like Brent said earlier, I would more equate this with the general market when you're talking like SPY versus individual stocks, because individual stocks these days can be very volatile. But this helps big time knowing that if the general market is down 10%, so just kind of bring those stats a little more into focus. Based on these numbers, what we just showed you, corrections happen. The 10% corrections happen for the general market, something like SPY, on average 2.7 every 2.7 years, right? So roughly every 3 years, the market will see a 10% correction. What does that tell you, right? That tells you that the 10% correction in the market are relatively rare, right? So if you come in one day and see the S&P 500 down 2, 3, 4%, you should think in your mind, okay, that's not 10%. It's not that big of a deal. 10% is actually the big move. The market being down 2, 3%, not really that big of a deal. Once you hit 10% in the general market, then it becomes a big deal, and that's very rare. So, like we always say, the market never goes up, in a straight line. So when you do see these 2, 3, 4% pullbacks, they're fine. They're the normal heartbeat of the market. But when you get to that 10%, that's when you kind of say, okay, something's really going on here with the general market. And then of course, bear markets, they happen on average 7.1 every 7.1 years. So those are even more rare, right? So if you ever see a 20% correction in the S&P 500, tracking it by SPY, then we know something really big is going on, like COVID last March. The market was down 35%. At some point, it hit 20%. We knew why, because it was, it was COVID. So just know that 20% is very rare. And then corrections are also rare. They're more frequent than bear markets, but they're also rare, and then they happen roughly every 3 years. So again, knowing that information, if you see the general market down 2, 3, 4%, not a big deal, because corrections happen about every 3 years, and that 10% is the number you want to look at. 2, 3, 4% down for the general market is not really that big of a deal.
Cool. Well, I mean, for everybody who's listening, we hope you take this information, use it to, number one, educate yourself, educate those around you. And again, if you're listening to the podcast, you're watching us live, this is our challenge to you. Call to action. Let's make our ecosystems better, stronger, and more financially aware. Ask somebody, send this to a friend, ask a coworker, ask somebody you're close to how they save their money. And just say, I was listening to these guys in Investing Education Academy, and they said to do it, so I'm just doing it as a challenge. How do you save your money? Do you keep your money in a savings account? If they say yes, ask them if they know what the interest rate on their savings account is. If it's anything below 1%, it's going to take their money at least 72 years to double. Now, let's put that into perspective. If you can just hit 10% in your account, your money now doubles every 7.2 years. If you can hit 10%, which I'm not gonna say is not a lot, but it is achievable.
And that 10% is with the S&P 500 returns on average.
On average, yeah, right. Yeah. And so if you can get that 10% every 7.2 years, your money's gonna double. So you would have went from 72 years, your money doubling, to every 7.2 years. And to put it into perspective, again, inside of IAA, in one of the groups that's formed in IAA, we know at least 80% of the group did over 40% rate of return last year alone. So, what groups are you a part of? I wonder. I hope it's a group. So, do what you will with that information. We owe you all 2 stock picks. We have a doozy of a pick today. One of them, can't tell you what it is. You got to go to Investing Education Academy group on Facebook, and you'll find Leon and our stock picks for today. But I'm going to tell you, one of them deals with the safety of cars in the future. I'm trying to think of a way to say it, but I'll give you too much. So it revolves around the safety of cars in the future. And as you know, that's a pretty big space. So you got to go to Investing Education Academy, to the group on Facebook, to find out what the actual picks are. And if you're not a member of the group, please join. It is free. And join in the conversation. Don't just check the stock picks and then leave. Tell us who you are, get in there. Add some, if you know about a stock we should be aware of, please add it. It is not a place for self-advertisement, but it is a place for sharing good information. And if you're thinking about becoming an Investing Education Academy member, which again, thank you to all of the members who joined in the last 2 weeks, you can do so by going to www.ieanow.com. And we have membership discounts ranging from 20% to 50%. I would say everybody should take advantage of it. If you haven't joined yet, you should definitely give it some true consideration right now. Leon, am I missing anything?
No, that was it. And just to find the group on Facebook, just go to Facebook. Just go to Facebook and search Investing Education Academy, and our Facebook group should pop up. And yeah, just join that way.
All right, everybody, thank you for being with us. We will see you next Wednesday, and we hope when you see us, you'll share the link with a friend, coworker, family member, or other. And if you're listening to the podcast, please send the link to somebody you're close to and have a discussion about the content later on. Have a great day.